Welcome to Iron Financial. Our mission is simple: forge stronger portfolios by cutting right through the market weakness. Today, we're putting on the hard hats and grabbing the blueprints to deconstruct Take-Two Interactive. Their latest earnings report just hit the street, and yeah, the market seems to be cheering, but our job is to stress test the very foundation of this company. Are we looking at solid rock, or is it all just sand? All right, let's get to work. Okay, right out of the gate, CEO Strauss Zelnick hands us the master plan. Now listen, this quote isn't just some corporate soundbite. It's the entire bull case, the whole argument, squeezed into one powerful sentence. He's not talking about next quarter. He's not even talking about next year. He's pointing all the way out to fiscal 2027. He's telling investors, look, we are laying the foundation for a massive skyscraper right now. And he's saying that once it's built, the company's entire financial profile, their baseline, is going to be permanently lifted to a whole new level. This is the promise of a new era. This is the vision they're selling you. Whoa, hold on. A new baseline? A skyscraper? That vision sounds great, but I'm looking at the wet cement and the rusty rebar on the ground right now. Because on one hand, you've got the hype, right? The stock pops 4% after hours. The market clearly heard that vision and they are buying it, hook, line, and sinker. But then you've got the other hand, the cold, hard reality of the numbers. Take-Two reported a wider than expected loss. Let me say that again. They were supposed to make money, and instead, they lost money. So my question is pretty simple. Which is it? Is the market seeing some brilliant blueprint for the future, or is it just high on hype, completely ignoring a crack that's already showing in the foundation? And that is the billion-dollar question. It's exactly what we're here to figure out. So here's our blueprint for today's deep dive. First, we're going to tackle those headline numbers, that exact conflict between the hype and the reality. Then we're going to forge the top line, and I mean really examine the steel beams of this business. After that, you bet we're going to look for cracks in the foundation. We're talking about the losses, the accounting, the whole deal. Then we have to talk about the ultimate catalyst, the elephant in the room, GTA 6. We'll gauge the company's own outlook before we deliver our final iron verdict. All right, let's do it. Section 1, the earnings headline. Like I said, this thing tells two completely different stories. You've got the positive market hype on one side and the negative bottom line on the other. You know, most investors, they see a stock go up after a report and they just assume everything's great. Our job is to grab a shovel and start digging. And this is the first thing we find. Wall Street's so-called experts, they were expecting a profit of 83 cents per share. That was the bar, that was the target. What did Take-Two actually deliver? A loss of 50 cents per share. Now look, this isn't a small miss. This isn't a little oopsie. This is a massive, gaping chasm between what was promised and what was delivered. So how in the world can a company be rewarded by the market for fundamentally failing to hit its profit targets? It tells me one of two things. Either the market is ignoring a huge weakness, or it's focused on a completely different set of numbers. We need to find out which one it is. You're right, it's the second one. The market is looking at a completely different set of metrics. And while that gap loss is a real concern, and I promise you we are going to get to it, to understand the bull case, you have to look past that bottom line for a second and examine the real load-bearing beams of this business. The sales momentum. Let's talk about net bookings. $1.76 billion. That's the net bookings number for the third quarter. This is the number that drove that 4% pop in the stock. And what's so crucial here is that this figure didn't just meet what people were hoping for. It was above the company's own guidance. That tells you that operationally, the business is absolutely firing on all cylinders. They're selling more games, more content than they even thought they would. This is the raw steel showing up at the construction site. And guess what? The shipment is bigger than we ordered. And you can't just look at that number in a vacuum. It represents powerful, serious acceleration. Net bookings grew a staggering 28% compared to the same quarter last year. In this economy, with everyone worried about the consumer, about people pulling back on spending, a 28% growth rate in your core operational metric is a massive signal of strength. This is not a company that's hitting a wall. This is a company that's actively expanding, proving there's huge demand for what they sell. This is the heavy lifting investors want to see. Now here is where the foundation gets really, really solid. 76%. 76% of all those bookings came from what the company calls recurrent consumer spending. What is that? Well, think virtual currency in their games, think add-on content, in-game purchases, all that stuff. This is not about selling you a $70 game one time and hoping you come back in 5 years. No, this is about continuous engagement, continuous monetization. A 76% share means this business is built on a stable, predictable, almost subscription-like revenue stream. That provides a durable, all-weather foundation that can support the whole company through the ups and downs of big game launches. So, the big question is, where's all this cash coming from? If you look back a decade ago, Take-Two was pretty much just a console gaming company. But look at this mix today. Mobile, mostly through that huge Zynga acquisition, is the single largest piece of the pie at 49%. This is a beautifully diversified portfolio. They aren't just shackled to Sony's or Microsoft's hardware cycles anymore. They have a massive business that literally sits in the pockets of billions of people on their phones. This kind of diversification, it makes the entire structure way more resilient to shocks. And that diversification, it carries over to their franchises, their intellectual property. Everyone thinks of Take-Two as the Grand Theft Auto company. And yeah, GTA is an absolute monster. But just look at this list. You've got the sports behemoth NBA 2K printing money every year. You have the enduring powerhouse of Red Dead Redemption. And now you've got this whole slate of mobile giants like Toon Blast and Match Factory, and each one of those is a major revenue stream all by itself. This is not a one-trick pony. These are all critical load-bearing assets holding up the roof. Okay, that's a very, very rosy picture of the steel beams and the framework. That's great. But a building with a great frame that's losing money every single quarter is still a bad investment. You've talked around it long enough. Let's get under the hood. Let's talk about GAAP, generally accepted accounting principles. Let's talk about the reported net loss. It's time to stop looking at their special operational metrics and start looking at the actual audited profit and loss statement. And here it is, in black and white, a GAAP net loss of $92.9 million. So let me ask the question again, as plainly as I possibly can. How does a company with record bookings, 28% growth, and all these powerful franchises manage to lose almost $100 million in a single quarter? Where is money going? Is this a sign of terrible cost control? Is the foundation not nearly as solid as it looks? This is a significant crack, and you can't just plaster over it with some non-GAAP metric you made up. It's not about plastering over it. It's about understanding you need the right tool for the right job. Net bookings is an operational metric. It is the most direct measure of their sales momentum and, more importantly, their future cash flow. The GAAP loss, on the other hand, includes a lot of non-cash expenses that can really obscure that immediate operational picture. But does it obscure or does it clarify? One metric shows you sales, the other shows you profitability. I'd argue that profitability is what actually matters at the end of the day. You're telling me what the business could be. I'm showing everyone what it is right now. Okay, let's just look at the reconciliation. Let's look at the bridge that gets you from one number to the other. You start with that GAAP net loss, the negative $92.9 million. Then you add back certain expenses. The biggest one on the list by far is amortization of acquired intangibles at almost $168 million. Now, think of this as the on-paper accounting cost of that huge Zynga acquisition being spread out over time. It's a real cost, sure, but it is not cash that is leaving the building this quarter. Once you adjust for that and a few other things, you arrive at a positive EBITDA of nearly $175 million. That is the true operational profit engine. Hold it right there. Non-cash charge? They paid billions of very real dollars for Zynga. That amortization is the cost of that purchase being recognized. You can't just wave a magic wand and pretend it doesn't exist because it's inconvenient for your profitability narrative. It is a real cost of doing business. This isn't an engine. It's an accounting trick to make a money-losing operation look profitable. Look, I understand the skepticism around the accounting. So let's put the debate about GAAP versus non-GAAP on the shelf for just a minute and talk about the single biggest factor in this entire equation. The one asset that, in the long-term view, makes all of these numbers almost irrelevant. Let's talk about the ultimate load-bearing asset for Take-Two's future, the launch of Grand Theft Auto 6. This is the date, November 19th, 2026. This is not just another product release. This is, arguably, the most anticipated entertainment launch in history. Grand Theft Auto 5 has sold over 200 million copies. It has generated billions upon billions in revenue. The expectation, the baseline assumption, is that GTA 6 will be even bigger. The CEO's entire projection for that new financial baseline in fiscal 2027, it rests entirely on the monumental, earth-shattering commercial success of this one single title. It's the catalyst designed to reshape the entire financial structure of the company. A catalyst that is far, far from guaranteed to arrive on time. Let's not forget the history here, folks. As this quote points out, this game has already been delayed. The pressure to deliver a perfect, groundbreaking, flawless product is absolutely immense. And complex software development like this is just fraught with risk. So while all the bulls are busy penciling in billions of dollars starting in November 2026, there is a very real execution risk that this date could slip again. And if it does, the entire bull case gets pushed out, and that could rattle investor confidence in a big, big way. And that brings us to the most critical question of all, doesn't it? Is it a sound strategy to place this much weight on a single asset? We're talking about a $40 billion market cap company whose entire future narrative hinges on the flawless execution and historic success of one product. What if it's only a massive hit and not the cultural and financial atom bomb everyone expects? The market right now is pricing in utter perfection. Any deviation from that, a delay, a mixed reception from gamers, anything could cause severe structural damage. So is this a solid foundation, or is it a dangerously high concentration of risk?
That's a fair question. It's a huge concentration of risk. But we don't have to just guess about the company's confidence level. They gave us their own forecast. They published their own blueprint for the rest of the fiscal year. So let's analyze management's own guidance, because it tells us a lot about how they see the business performing right now, today, even before GTA 6 lands.
And this slide right here is the whole debate in a nutshell. Look on the left, they are now projecting up to $6.7 billion in net bookings for the full year. Raising guidance is a clear signal of operational strength and management confidence. Confidence in sales? Maybe. But I have to point right back to the other side of the screen. Even with that stronger sales forecast, they are projecting a full-year net loss of up to $2 per share. They are telling you directly, we are selling a lot of stuff, but we are still losing a lot of money. It is the exact same conflict, just projected out for the entire year. All right, we've examined the headline numbers, we've stress-tested the top-line growth, and we've inspected the cracks in the GAAP foundation. We've weighed the colossal potential of GTAV against the very real execution risk. It's time to put it all together. It is time for the iron verdict. Is Take-Two an opportunity, or is it a trap? So at the end of the day, it all boils down to this. The bull case is built entirely on forward-looking operational strength. You've got that powerful 28% net bookings growth, you've got a stable foundation of recurrent revenue, and you have the mother of all catalysts in GTA 6, which promises to literally rewrite the company's financial story. And the bear case? It's rooted in today's reality. The GAAP losses are real, they are not imaginary, the earnings miss was significant. And the company's entire valuation feels dangerously reliant on one single game launching perfectly on time. You're being asked to ignore current, real losses for a future promise that carries very, very real risk. And that brings us to the final question, the one that only you can answer. There is absolutely no doubt that Take-Two is a company under construction. They are spending heavily, they're absorbing these non-cash charges, and they're posting GAAP losses right now, all in an effort to build a financial fortress for 2027, centered around the launch of GTA 6. The bulls see a skyscraper in the making. The bears see a costly, messy project that's bleeding money today and has a major single point of failure. So the question for you is this. Is your portfolio built to withstand the noise, the volatility, the headlines of this construction phase for the potential reward when that skyscraper is finally complete? That's a decision you have to forge for yourself.